As we are preparing for the upcoming rate cut and its implication on the economy, there's a need to understand the monetary policy shift that comes with the rate cut. In this video, you will learn all that the expected rate cut entails and how it could affect the economy. Come with us as we delve into the reasons for the Fed's move on the upcoming rate cut, how these changes in rate cuts could affect every economic sector from the stock market to the consumers, how to prepare for this financial shift as an individual and a business owner.
You must have heard about the Fed's move on the upcoming rate cut from the most recent FOMC meeting. But why did the Fed make such a move? What does it mean to the stock market and you as an individual? And how do you prepare for the outcome as an individual and a business owner? Join us as we discuss the Fed's move, its economic implication, and how to strategically prepare for this shift. There is a system known as the Federal Reserve System, and the body that governs this system is known as the Board of Governors of the Federal Reserve System, or the Federal Reserve Board, FRB. The FRB was established by the Banking Act of 1935, tasking its members with giving a fair representation of the financial, agricultural, industrial, and commercial interest and geographical divisions of the country. To be more specific, in the US, the Federal Reserve Board, popularly known as the Fed, is responsible for setting the target interest rate at which banks borrow and lend money to one another, known as the federal funds rate, which in turn has a ripple effect across the entire economy. To make things clear, there is a division within the Federal Reserve Board, which is the chief body of monetary policy. FOMC stands for the Federal Open Market Committee. This committee is the chief body tasked with monetary policy, as stated earlier, and whatever decision this body takes is decided by votes. Its voting membership combines the 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 other Reserve Bank presidents. All Reserve Bank presidents need to attend FOMC meetings even when they are not designated voting members. The FOMC is headed by the chair of the Board of Governors, a tradition that has existed and has been practiced for years. The FOMC, however, includes both rotating and permanent voting seats for a total of 12 reserve banks. So who are the people who voted at FOMC meetings and how does the rotation happen? By design, the Federal Reserve System is decentralized with 12 Federal Reserve banks rooted in communities across America. This is to ensure that the decision makers of monetary policy hear different perspectives. Although most bank presidents vote on a rotating cycle, all have a seat at the table during FOMC meetings, and they bring the voice of Main Street to the table too. Before FOMC meetings, bank presidents take their time to assess real-time and on-the-ground economic information. So when it's time for the meetings, they actively participate in discussions and share their views on the policy they believe is the most appropriate for the economy. However, the Fed has been given dual mandate objectives, which are maximum employment and price stability. With the wealth of up-to-date national, international, and regional information, the FOMC discusses the monetary policy options that would best move the economy toward these objectives. At the end of the FOMC meeting, the committee comes up with a decision on the stance of policy. For this power held by the FOMC, all eyes are on the upcoming FOMC meeting, with the next FOMC meeting set to be held on January 31st, 2024, there's so much anticipation on what the decision of the committee may be. This date is important to investors, economists, and policymakers that they mark their calendars in anticipation, and it's all because of the rates. What many experts expect is that the Fed will hold rates steady as a target of 5.25% to 5.50%, but the FOMC has signaled several rate cuts through 2024 as inflation eases and the economy slows, all of these while they proceed carefully. The expectation came as a result of the most recent FOMC meeting that was held on the 13th of last December 2023. Where interest rates were kept unchanged at 5.25 to 5.50%. However, experts predicted the Fed's move correctly, as this move gives the Fed additional time to evaluate if the current rates keep inflation at bay without impairing economic growth too much. And now, the FOMC has mentioned that at least 3 rate cuts could be in the cards for 2024 as inflationary pressures abate and economic growth cools. Within the 2022-2023 cycle, the Fed increased its rates 11 times to slow inflation, but one thing is the rate has been held steady at 5.25-5.50% since July this year. Going into December 2023 meeting, the expectations were somewhat considered dovish. To understand what dovish means, Dove is an economic policy advisor who promotes monetary policies that usually involve low interest rates. Doves tend to support low interest rates and expansionary monetary policy because they value indicators like a low unemployment over keeping inflation low. If an economist suggests that inflation has few negative effects or calls for quantitative easing, then they are called a dove or labeled as dovish. Most suspected rates would remain unchanged, but some analysts still believed that the Fed could resume hiking its benchmark borrowing rate increases after hawkish pauses in June and September, saying that although inflation has moderated, it remains a key concern. What does it mean to be hawkish? Hawks are the opposite of doves, and they can be seen as willing to allow interest rates to rise to keep inflation under control. After the September 2023 meeting, Fed Chairman Jerome Powell hinted that one more hike before 2023 was over was still in the cards. This did not happen as the Fed's aggressive rate hiking campaign in 2022-2023 seemed to have already done the job. According to the Fed Chair Jerome Powell, no decisions about the future have been made, and the Fed will take it meeting by meeting. While many investors and analysts expect the central bank to continue to hold rates steady, the Fed faces the risks as persistent high interest rates can negatively affect the banking sector, stock market, and trade. These factors could weigh on its next rate decision, so there is now a chance that the FOMC will reverse course in 2024 and begin cutting rates. Indeed, the Fed had mentioned several rate cuts during the year. This, of course, will depend on the trajectory of inflation and the state of the economy. After the December Fed announcement, the market assigned around an 85% probability of rates holding steady at the January meeting. Whatever the decision of the Fed, they will also monitor credit conditions, the financial markets, and global developments closely to make any decision putting in mind the goal of achieving a soft landing for the US economy. The Fed's rate hiking campaign has been the most aggressive since the 1980s, and it sparked some turmoil in the banking sector, the stock market, and the global economy during this period. However, rates at 5.5% are still less than half of their 1980s peak. According to the Fed in December, the American economy remains strong and the labor market remains resilient. However, they also acknowledge that the pace of growth had slowed down compared to the first part of 2023. The Fed revised its economic projections, expecting slower growth, higher unemployment, and moderated inflation next year. Experts expect the Fed to continue to hold rates steady through the beginning of the year before making cuts, barring any sudden macroeconomic events. Let's start by explaining what a basis point means. A basis point is a common unit of measure for interest rates and other percentages in finance. The word basis in the term basis point comes from the base moved between two percentages, or the spread between two interest rates. Basis points are typically expressed with the abbreviations BP, BPS, or BIPS. They are used to show the change in the value or rate of a financial instrument, such as 1% change equals a change of 100 basis points and 0.01% change equals 1 basis point. You can also say that they are commonly used for calculating changes in interest rates, equity indices, and the yield of a fixed income security. Most commonly, what you find quoted in basis points are bonds and loans. Here's an example. Let's say the interest rate offered by your bank is 50 basis points higher than the secured overnight financing rates, the SOFR. A bond whose yield increases from 5% to 5.5% is said to increase by 50 basis points, and the interest rates that have risen by 1% are said to have increased by 100 basis points. This table gives a more detailed and simple explanation of the conversion. When basis points are used, traders can be sure that there are no ambiguity and the rate is clearer. This way, we can make sure that there are no trading mistakes. Plus, Values are well communicated. Traders take clarity very seriously since the values of financial instruments are often highly sensitive to even small changes in underlying interest rates. If the Federal Reserve Board raises the target interest rate by 25 basis points, it means that rates have risen by 0.25 percentage points. If rates were at 2.5% and the Fed raised them by 25 basis points, the new interest rate will be 2.75%. By using basis points in the conversion, traders and analysts remove some of the ambiguity or confusion that can arise when talking about percentage moves. Here's another example. If a financial instrument is priced at a 10% rate of interest and the rate experiences a 10% increase, it could conceivably mean that the financial instrument is now 11%, meaning 0.1 times in bracket 1 plus 0.1, or it could mean that it is now 20%. 10% plus 10% equal 20%. In this case, the use of basis points makes what we are trying to communicate clearer. If the instrument is priced at 10% rate of interest and experiences a 100 BP move up, its rate would then be 11%. If the instrument experiences a 1000 BP move up, it would be 20%. Now that we've discussed the basis point, let's talk about them. One reason the Fed might be able to cut rates next year, even if the economy plows ahead, would be if inflation kept falling as expected. A steady slowdown in price increases would have the effect of raising inflation-adjusted interest rates, thereby making borrowing costs higher than the Fed intends. Reducing rates in this scenario would simply keep inflation-adjusted borrowing costs from rising. The reason for this shift came after all except 2 of 19 Federal Reserve officials predicted the central bank would cut interest rates at least once in the coming year, according to the Fed's latest summary of economic projections. And while almost every official believes we will see a total of 3 rate cuts in 2024, one Fed official has predicted 5 rate cuts. Investors were thrilled by these new predictions and sent the markets soaring. But even though rate cuts are generating a lot of buzz with investors, they are not a sure shot by any means. As in the summary of economic projections, SEP notes, Fed officials' projections on the future path of interest rates are subject to considerable uncertainty, they say. How so? That's because their assessments of the appropriate monetary policy to apply in the future all depend on how the economy performs. To put it in their terminology, all the data will be reviewed. For example, if inflation runs a lot hotter than officials expect, the Fed may opt to pause or raise interest rates instead. But assuming the majority of Fed officials' predictions turn out to be true and the central bank does start cutting interest rates next year, what would the justification be? Let's go back to the onset of the pandemic back in March 2020, the last Fed cut rates. Over a series of emergency meetings in March 2020, the Fed took the unprecedented step of slashing interest rates by 1.25 points, which brought rates to near zero levels. The Fed explained the cuts were needed to counter the dangers COVID posed to the economy. Before the pandemic, the Fed cut rates in 2019 as the trade war between the United States and China was heating up, as the first of 3 cuts that year came in July. Jerome Powell explained that the quarter-point cut was necessary to ensure against downside risks from weak global growth and trade policy uncertainty, and to help offset the effects these factors are currently having on the economy. According to Powell, the first cut and the subsequent ones that year were mid-cycle adjustments, meaning this was not the start of a lengthy round of rate cuts, but rather a minor tweak to reroute the economy. But when there's a recession or a severe downturn, the Fed would act differently. This brings us to answer the question, why does the Fed cut rates? The 2 most recent cases of rate cuts highlight 2 primary reasons the Fed lowered its benchmark lending rate. The first reason was clearly stated by Justin Widner, a US economist at Deutsche Bank. He said, the Fed cuts rates when something goes wrong in the economy. This was the premise for rate cuts that began in 2007, 2001, and 1990, which marked the start of different recessions. Here's another reason. The Fed also cuts rates in response to data that shows the economy is losing steam or after events like 9/11 when there was a terrorist attack. That sort of event could be thought to generate weakness across the economy, according to Michael Gapen, head of US economist at Bank of America Securities. However, rate cuts don't always have bad roots. In the case of the predicted rate cut, there's a good chance it's not because there's an imminent risk of a recession or a need to insure against one. Gapen said, "This cutting could be different than any other time." In his view, the Fed would cut next year because inflation has moved closer to the central bank's 2% target. He also added that if that pans out, the Fed's current target interest rate level will be overly restrictive and put a drag on the economy. From all we have heard Powell and Wetness say, we see that experts are not ruling out a recession in 2024. Wetness' team predicts the unemployment rate will rise to 4.6% by the third quarter of next year from the current 3.7% rate as a result of a drop in the nation's real gross domestic product. Should that happen, it would be a bad scenario that warrants rate cuts. If this happens, what will happen to the stock market and investment? Usually, the effect of a change in the interest rate on the economy takes at least 1 year, but the stock market responds almost immediately. Markets will often attempt to price in future expectations of rate hikes and anticipate the actions of the FOMC. Besides the federal funds rates, the Federal Reserve also sets a discount rate. The discount rate is the interest rate the Fed charges banks that borrow from it directly. This rate tends to be higher than the target federal funds rate to encourage banks to borrow from other banks at the lower federal funds rate. If a company is seen as less profitable because of higher debt expenses or less revenue, the estimated amount of future cash flows will drop. In turn, this will lower the price of the company's stock. Now, if enough companies experience declines in their stock prices, the whole market, or the key indexes many people equate with the market, will go down. With a lowered expectation in the growth and future cash flows of a company, investors will not get as much growth from stock price appreciation. This can make stock ownership less desirable. Furthermore, investing in equities can be viewed as too risky when compared to other investments. However, it's not all bad. Some sectors tend to gain from interest rate hikes. And if there is any sector that tends to benefit the most, it is the financial industry. Banks, brokerages, mortgage companies, and insurance companies' earnings often increase as interest rates move higher because they can charge more for lending. The stock market isn't the only thing impacted by interest rates. There are also bond prices and the return on certificates of deposits, CDs, treasury bonds, and treasury bills. There is an inverse relationship between bond prices and interest rates. In other words, as interest rates rise, bond prices fall, and vice versa. The longer the maturity of the bond, the more it fluctuates following changes in the interest rate. When the Federal Reserve raises the federal funds rate, newly offered government securities, such as treasury bills and bonds, are often viewed as the safest investments. They will usually experience a corresponding increase in interest rates. In other words, the risk-free rate of return goes up, making these investments more desirable. As the risk-free rate goes up, the total return required for investing in stocks also increases. Therefore, if the required risk premium decreases while the potential return remains the same or dips lower, investors may feel stocks have become too risky and will put their money elsewhere. Government and businesses raise their money through the sale of bonds. When there's an increase in interest rates, the cost of borrowing becomes more expensive for them, resulting in higher yielding debt instruments. Simultaneously, market demand for existing lower coupon bonds will fall, causing their prices to drop and yields to rise. Conversely, as interest rates fall, it becomes easier for entities to borrow money, resulting in lower yielding debt insurances. Simultaneously, market demand for existing higher coupon bonds will increase, causing their prices to rise and yields to fall. Incidentally, in this type of environment, issuers of callable bonds may choose to refinance them and lock in the prevailing lower rates. For income-oriented investors, when the Fed reduces the rate, it means less opportunity to make money from interest. The decrease in interest rate will push investors to remove their money from the bond market and put it into the equity market. Therefore, the influx of new capital makes the equity market to rise. Also, growth stocks like Amazon and Netflix that always rely on capital for future business expansion feel the effect of interest rates. When the interest rates are low, growth stocks have a higher chance of growing faster as capital can be gotten cheaply. And when the interest rate rises, growth stocks become less favorable because their long-term discounted cash flow is reduced and their ability to secure low-cost debt financing is more difficult. According to S&P Global Market Intelligence data, global annual GDP is forecast to grow at a slower pace of 2.3% in 2024, compared with an estimated 2.7% in 2023. According to Fitch Ratings forecasts, world economic growth will fall sharply to 2.1% in 2024, compared to its revised forecast of 2.9% in 2023. As credit slows, the lag effects of monetary tightening will weigh on US growth next year. As a result, investment will weaken, making household income and profit growth fall. According to Colton of Fitch Ratings, real interest rates will also rise as the Fed is slow to cut rates while inflation falls back. If you're worried about a recession in the US, it is unlikely going to happen as experts have predicted. This is because there are various supports for growth which they think will keep recessionary conditions at bay. Instead, we should expect to see the US economy slow down in the same way we have seen other regions, including Europe. Most of Western Europe is already in recession, and that is a result of the increase in energy prices and changes in the sources of energy following Russia's invasion of Ukraine. According to the economists, Asian economies had a different approach from advanced economies of the West due to relatively lower levels of inflation, which led to limited responses from central banks and consequently less negative impacts on economic activity. This is the reason why experts have said that Asia Pacific will continue to be the main growth engine in 2024. According to Fitch Ratings baseline forecast, the Chinese economy will grow by 4.5% in 2024. However, with the housing collapse ongoing, there are downside risks. The main medium and long-term risk for Asian countries is a slowdown in China due to the significant trade links. This slowdown in China will particularly affect Singapore, Hong Kong, Vietnam, and South America. Both China and India will grow more slowly than in previous decades due to high interest rates and structural factors. Whether you're a short-term or long-term fixed income investor, you should not be caught unprepared for this predicted shift. This is because those caught unawares may miss out on an easy opportunity to increase their monthly incomes. For this reason, we will talk about how to prepare for this shift in the interest rate environment. When interest rates are rising, Every investor should reduce long-term bond exposure while they beef up their positions in short and medium-term bonds. This is because they are less sensitive to rate increases than long maturity bonds that lock into rising rates for longer periods. But flipping to shorter-term, lower-yielding bond model as a trade-off, as short-term bonds provide less income earning potential than longer-term bonds. Here's a solution to this problem. Short-term bonds should be paired with other instruments, including floating rate debt, such as bank loans and treasury inflation-protected securities named TIPS, whose adjustable interest rate is less sensitive to rising interest rates than other fixed-rate instruments. According to Geert Beckert, a professor of business at Columbia Business School, if future interest rates rise because of high inflation, for example a commodity price boom, and inflation risk is suddenly priced in again, nominal treasuries will perform very poorly, but TIPS, so Treasury Inflation Protected Securities, will do well as they are indexed against inflation. TIPS are adjusted twice a year to reflect changes in the US Consumer Price Index, CPI, a benchmark for inflation, as you should know. If price levels rise, the coupon payments on TIPS will respond similarly. As for floating rate loans, these instruments invest in riskier bank loans, whose coupons float at a spread above a reference rate of interest. Thus, they adjust at periodic intervals as rates change. Another thing to do If you as an investor are willing to cash in when rates are high, you should consider purchasing stocks of major consumers of raw materials. Usually, the price of raw materials remains the same or sometimes declines when rates rise. Every company in need of these materials for producing a finished good or simply in their day-to-day operations will see a corresponding increase in their profit margins as their costs drop. For this reason, these companies are seen as an edge against inflation. Also, the real estate sector would be happy about raising interest rates. Therefore, any company that profits from home building and construction may be good players as well. Poultry and beef producers may also see an increase in demand when rates rise, due to increased consumer spending and lower costs. Are you taking notes? Here's another thing to know. The bond ladder is a common strategy that most financial planners and investment advisors will recommend to clients. A bond ladder is a series of bonds that mature at regular intervals, such as every 3, 6, 9, or 12 months. As rates rise, each of these bonds is then reinvested at the new higher rate. The same process works for CD laddering. Let's look at an example that illustrates this process. A man has $300,000 in a money market, earning less than 1% interest. His broker advises him that interest rates are probably going to start rising sometime in the next few months. He decides to move $250,000 of his money market portfolio into 5 separate $50,000 CDs that mature every 90 days starting in 3 months. What this means for this man is that every 90 days, he reinvests the maturing CD into another CD paying a higher rate. He may invest each CD into another of the same maturity, or he may stagger the maturities according to his need for cash flow or liquidity. Here's a warning. When rates are low and inflation is high, tangible assets such as gold and other precious metals tend to do well. Unfortunately, investments that hedge against inflation tend to perform poorly when interest rates begin to rise simply because rising rates curb inflation. The prices of other natural resources such as oil may also take a hit in high interest environments. This is bad news for those who invest directly in them. Investors should consider reallocating at least a portion of their holdings in these instruments and investing in the stocks of companies that consume them instead. Also, rising interest rates mean that more conservative instruments will begin paying higher rates as well. Furthermore, the prices of high-yield offerings such as junk bonds will tend to drop more sharply than those of government or municipal issues when rates increase. Therefore, the risks of high-yield instruments may eventually outweigh their superior yields when compared with low-risk alternatives. While we know that interest rates will not stay low forever, the speed at which rates rise and how far they climb is difficult to predict. Those who pay no attention to interest rates can miss out on valuable opportunities to profit in a rising rate environment. Again, there are different ways that investors can profit from rising rates, such as buying stocks of companies that consume raw materials, laddering their CD or bond portfolios, taking bets on dollars, refinancing their homes, and reducing risks. To know more ways you can profit from changes in interest rates, you should consult your financial advisor. Are there other strategies that we didn't mention? What are your thoughts on the expected rate cut? Kindly share with us in the comment section. See you in the next video.